Hi everyone, welcome back to the Gelato pod. I'm really excited about today's episode. With me today is Michael Bentley, a co-founder and CEO of Euler. By the way, that's a pretty sick surname that you have there. So you have to tell me, definitely have to tell me where it comes from. But I hope someday you're also driving a Bentley. But yeah, if you're listening to this today, we will go pretty deep into newly emerging DeFi primitive that I'm pretty excited about. Us at Arrakis are sort of like working with, which is the concept of credit-based market making or just-in-time market making. It's sort of like the convergence of AMMs, decentralized exchanges, lending, borrowing markets. And of course, there's no one better to talk to about this topic than Michael. And yeah, so first of all, hey, Michael, thanks for being on the pod.
Yeah, great to be here. Thanks for having me. Yeah, on the surname, that I don't own a Bentley. That's yeah, I'm actually not a huge fan of them, really. I'm not really a car person. They seem a bit sort of like in your face, a little bit aggressive. So no, sadly not part of that dynasty. I have no idea where it comes from. It's a relatively common surname, I would say, in the UK. I'm not from like landed gentry or something and some fancy like stock in the UK. No, just a regular person.
An honest farmer yourself.
An honest farmer, yeah, exactly. Yeah.
Yeah, nice. Yeah, maybe you're more the Lambo guy. No, I'm just kidding. Yeah. Cool. So yeah, that's the topic, and I think let's just dive into it.
Yeah.
And yeah, why am I so like excited about this? First of all, I think we've all seen the sort of shifts in the DEX lending DEX industry in terms of like volumes being facilitated. I think there are many protocols, a few protocols, including yours, that are really like picking up and eating market share. And so this is like a very sort of timely topic to talk about. And then, of course, also, I think talking to you guys at Euler, we've been working together on the Arrakis side as well. We have been using Arrakis Pro, our sort of on-chain market making solution for the oil token, which is great. So, of course, always happy to talk to a fellow founder and also customer our services as well. And yeah, so let's jump right in. Maybe before we go into the topic of just-in-time market making or credit-based market making, let's maybe first get a quick summary from you about Euler V2. I think it's kind of like the core building block, of course, on top of which everything is built here. So yeah, maybe very short from your side, how would you sort of explain it to people? And then also we had previous episodes on this channel about lending borrowing markets. Maybe you can compare it to some of the existing protocols like Aave and Morpho, for example, and sort of explain how you guys differentiate yourself a bit.
Yeah, sure. So yeah, Euler V2, I mean, at its core, it's a lending and borrowing protocol like the ones you mentioned. So, broadly speaking, people can collateralize assets and then take out loans against those assets. So deposit BTC and borrow ETH or borrow USDC. That's one of the early kind of popular trades. I guess more recently, we've seen emergence and growth of the stablecoin industry, and an increasingly popular trade then is more of like an interest rate carry trade type trade. So you would basically deposit something high yielding, borrow something that's lower yielding, and then kind of loop that or leverage it to amplify your exposure to the interest rate spread, basically. So yeah, the two kind of core use cases of Euler as a lending and borrowing platform. And how does it work? What's cool about it? Well, I think when if you look back at the earlier lending protocols, like the early Compound protocol or like Aave today, they were kind of monoliths, right? Big monolithic protocols where you have one big market and everything in principle is kind of cross-collateralized within that market. And so it's very much a specific product designed to capture a large amount of volume from the market. But the one thing it doesn't do well, I guess, is not very flexible. You can't really tailor it to tailor the product to lots of different like specific opportunities. All the risk and reward is all sort of encapsulated within that one big market. And of course, when it comes to credit, there are lots of lots of different opportunities that you can take, and every single person I've ever met always has a slightly different preference in terms of risk and reward, or just like preference in terms of how long they plan to keep a loan open for, or whatever. So yeah, credit is a massive market with lots of different opportunities, and those monoliths that aren't flexible enough to capture all of those, I would say. So what do you do about that? With Euler V2, we essentially built a developer's kit for building bespoke credit markets. And at the core of that developer's kit is the vault. So our primitive unit is a vault, and a vault just holds assets. Now, what can you do with those vaults? You can then connect them to one another and create relationships between vaults. So you build like a network. And so we have another primitive that handles communication between vaults. And so the simplest credit market you can build takes two of these primitive units. It takes a collateral asset deposited as collateral, and it connects it to another vault where the assets are then lent out. So the assets can actually leave and re-enter the vault. And so you have a simple pair, and that's the simplest credit market you can possibly create. And actually, that's the primitive that Morpho uses to build its markets up, I would say. So on Morpho, the lowest level, they just have a collection of pairs, collateral debt pairs. Now, on Morpho, the collateral debt pairs are very simple. So the collateral always remains in the vault whilst the loan's active, and you can only have one. You can only borrow one thing. On Euler, it's much more flexible than that. You can actually, from the vault in which you're doing the lending and borrowing, you can accept multiple collaterals at once. And the collaterals themselves can also be lending and borrowing vaults. So that means that you can have a situation where A borrows B and B borrows A, or you get A borrowing B, borrowing C, borrowing D. And so you can form very different sort of like network structures in terms of the credit markets. And overall, that's beneficial, I would say, because it allows people to curate these markets, the risk curators, who manage the risk and the setup. They have more flexibility in the types of things that they can create, and often that creates opportunities for more capital efficient models of lending and borrowing. And at its most complex, you can just create a network where you basically build your way back up to an Aave style. So yeah, Euler sits, I suppose, in some respects somewhere between Aave and Morpho. And in fact, you can build Morpho using the Euler kit, or you can build Aave using the Euler kit, but not the other way around. So that's how we position ourselves. We're like a developer's kit for building credit markets.
Nice. That's a great explanation. And sort of how I would sort of like, or I see it, or would summarize it, is that so like Aave is this system where you have this enshrined sort of like curator risk manager, which is the DAO, which of course has like under the hood potentially one or more multiple ones that are going through the DAO to manage the system. And the great thing about this is like one unified margin account or credit account where you can borrow cross collateral, and you don't suffer from liquidity fragmentation. But the issue is that you have these sort of like one size fits all markets of like, hey, this is the ETH market, this is the BTC market. Maybe there's some emotes or something that they also offered, right? But it doesn't scale, or it doesn't, let's say, in the current version, it's difficult to satisfy all the risk reward preferences of lenders and borrowers. Whereas Morpho goes like the other extreme and says, okay, we have more these isolated markets. You can completely customize your lending borrowing preferences. They have these metamorpho vaults, right? You can use curators to lend out to many of them, but still, like, they are not really interconnectable in a sense. And I think, and they suffer from like liquidity fragmentation to a certain extent. And where you want to get it, like where I see Euler V2 is sort of like you want to try to get the best of both worlds of hey, you enable like curation, but like from anyone, from risk managers, but you also allow different sort of like vaults to form networks to solve liquidity fragmentation with your Ethereum vault connector, I think it's called, right?
Yeah.
And yeah, so you basically want to provide flexibility and solve fragmentation at the same time.
Yeah, that's right. I mean, you can create setups where you maybe have like mini Aaves. You have like 5 mini Aaves, each curated maybe by a different person, or in our system, in the Morpho system, all the markets are ungoverned, they're immutable. In our system, you can do that too. You can just throw away governance basically, and then they become immutable and fixed. But you can, if there's a risk curator that wants to retain the governance, they can retain them, and then you get multiple like mini instances of Aave. And you can always opt in our system to accept somebody else's assets as collateral in your system, but not vice versa. When you accept someone else's assets as collateral, that doesn't impose any additional risk on them, right? They just get new utility, if anything. They're like, oh, I can now optionally borrow something else if I want, but you do expose all the assets within your own market to a new type of risk, right? Which is whatever you're exposing people to, the collateral risk of the new asset. So yeah, it allows you to create these kind of big networks, and that's actually really how credit expansion works in the real world, right? You constantly have people creating new products, and then people find ways to package those up into into groups, which then allows people to sort of collateralize them, bundle a bunch of mortgages together into a big, collection of mortgages, put a risk rating on it, and then use that as collateral to borrow something else, and so on. So this is really like how it all works in the real world too, I think. But in what's nice about it being on chain and all being facilitated through this connector, it's all very transparent, and you can actually see it happening and trace it back. So when big banks go under and they find it takes people years to figure out what went wrong, in our case, the risks are always there and verifiable on chain at any point in time and through history as well. So in the event that one of these markets does default or suffer from bad debt, then you can figure out exactly what happened, where it might impact on the rest of the network, and so on.
Yeah, totally. And yeah, for me, if I look at like the lending borrowing markets, I see sort of similar to like as Arrakis, of course, we operate on like the spot markets and so like in the trading world predominantly, of course, like trading and lending are sort of like merging. I think we will talk about this in a second. But yeah, I think that the trading world already went on-chain spot trading world already underwent this sort of transition to sort of very sort of one-size-fits-all sort of preferences that were enforced on people to this sort of like very flexible preference creation, or like intent systems where you can just like, hey, this is what I want to do, right, with my borrowing, with my trade, with my maker order or taker order. I think something similar probably will happen in the lending borrowing rate, where it's all about these risk preferences that people want to create, right? Like I want to lend under this risk and reward assumptions. I want to borrow under these risk reward assumptions, and hey, please create a system that allows me to express them and then get them matched. And I think you took a very interesting way to facilitate this. So one question here, what I find quite interesting is of course there's this protocol, and then there's also like, let's say the go-to-market or the philosophy of how you want to actually create growth, right? And I think for like I think you guys have a pretty unique sort of philosophy from how I view this on the outside. So if you look at Aave, it's very much like this sort of like DAO fund, right? It's basically sort of like a DAO fund that like manages it all, and you subscribe to that, right? And they are definitely doing a really great job on doing that. If you look at the TVL, right, then I think Morpho for me positions itself very much as like this, okay, we want to be this protocol and immutability and so forth, and we don't want to have anything to do with the rest and let other people do it. And of course you are, I think, more similar to that. But also you have like these Euler prime walls. You now build Euler Swap, right? So you are, let's say, more active on the in the building side on top of your protocol, it seems. So how do you think about that yourself? And did I summarize that correctly? And how do you view that?
Yeah, I think that's fair. That's fair. I honestly partly this was like it comes from like just a historical like contingency, I suppose. Like when we relaunched Euler V2, we had a system that in some sense was quite similar to Morpho's, or like built from, establishes a similar philosophy, as you said. And of course, when we launched, all the people that might have built on Euler were all preoccupied with Morpho. Frankly, that's the truth of it. They already had systems that were working. Morpho clearly is a system that works well for the risk curators and for lenders and borrowers, at least to some degree. And so when we launched, we wanted to we wanted to bring on board all these risk curators, but they were all like, we're already kind of busy doing this stuff on Morpho. And we're like, how do we tackle that? And effectively what we said was, well, why don't we allow the DAO or encourage the DAO to build its own stuff, and that way we can showcase the abilities of the platform to compete. And doing so, actually did help then spur on more interest in the platform. Once we built some markets through the DAO, other curators then got interested because they realized that they could do things on Euler that you just can't do on Morpho because of the different design decisions we made. And so we started going from there. So we have this kind of unique situation, I suppose, where on the one hand we have markets which are very much like Aave. Euler Prime is kind of like an Aave instance. It has fewer assets. It's maybe slightly more conservative these days, I would say, but it's effectively like an Aave type system. And then we have all these risk curator governed markets, and then we also have like ungoverned, fully immutable markets as well. And so there's I guess our design choices to allow for maximum flexibility have now been realized in terms of actually what's happened is people have taken advantage of that, and now we have pretty much an array of everything that you could possibly build a credit market. All the different types of credit markets are kind of there. We have some things that look a little bit like compound markets, some which look a little bit like silo markets. Obviously the Aave style ones we've said, and more like Morpho style, or like slightly maybe like enhanced or bigger Morpho style markets, I would say, as well. So and everything in between. It's there's a big array of different things.
Yeah, totally. I think that's totally understandable and reasonable. I think it's something similar that happened to us at Arrakis, where we sort of opt out. The very first version was very much like this protocol that we built for like on-chain market making on concentrated AMMs. This is like how it started.
Yeah,
and
I remember that.
And we said, hey, there can be these managers, and we built like tools for these managers and come in, and then we realized, okay, this is just like way too complicated for just random people to come in and be managers. And then we said, okay, we first need to show them how to do it and so forth. And then we realized, okay, actually we need to do it ourselves and become the best manager. And then this also then actually sparked interest from other people that saw the success and say like, hey, how can we be a manager ourselves and then leverage you as an infrastructure? So we are now also undergoing this process. It's usually I think in many startups the case, right? You build something, then maybe they are preoccupied, and then you show them what great things you can build on top, and then they come and knock at your door usually.
You have to be super flexible when you first launch, right? And I tried to explain this to the team. I said, we can't just sit around and wait forever for people to show up, right? We if you look at Euler's growth curves, obviously people have commented about like really meteoric growth in total deposits and things, especially since January. But we actually launched in September, and those first few months were kind of brutal. We just didn't really see much growth at all. I think we had there was about 10 million TVL in the protocol, and 4 million was DAO protocol and liquidity that was there from seeding it, and it was a really slow start. And I said to the team and made some comments in the DAO forum. I just said, like, we have to adapt or die. So let's figure this out and figure out a path forward. And then, fortunately, we were able to do that. But nice. you have to be very flexible in the early days of a startup.
Yeah, I think it was definitely the right call. So I think now it's a time to actually talk about the topic we teased at the very beginning. Which of course is Euler Swap and the concept of just-in-time market making. Maybe if you could just give us a quick explanation about what is Euler Swap, maybe first of all, and then also like of course how it works, and maybe simple terms for starters. We dive a bit deeper later, and then maybe also like what was your motivation behind building it, right? Because it's definitely an interesting sort of like path to take, and it definitely probably wasn't easy. So would be curious about these things.
Yeah, I guess I'll start with the kind of problem statement, which is, if you look on DEXs today, obviously something you guys are very familiar with. Some of the things that I think that they don't do well, or that are like inefficient, that people have wanted to fix. One is that, when you put liquidity into a DEX, it's often just used very inefficiently. In TradFi, when there are big exchanges, it's not that the assets are literally sat on the order book waiting to be swapped, right? They're often sat somewhere else, and in many cases they're earning yield in a bank or some other way, and then they're kind of bought back later. The people settle up on the books at the end of the day or the end of the week or whatever, right? And but that's not the case in DeFi. Right? We literally go and we put the assets into ticks on Uniswap or wherever else into pools, and the vast majority of the time, the truth is that they're not being utilized. Right? There are many blocks where there just aren't trades, so there's zero utilization. But even on blocks where there are trades, the utilization of your liquidity might be negligible or like only a small part of things. So yeah, they're generally liquidity used quite unproductively, I would say. The other thing is that people want to be able to, you have this valuable asset inside the DEX. And people want to collateralize it. They want to borrow against it for lots of reasons. Sometimes they want to borrow against it because they need access to liquidity. Sometimes they want to borrow against it because they can actually, trade on that. There's like an opportunity. They can borrow dollars in one place and they can use those dollars to make money elsewhere. Sometimes they want to just leverage the liquidity and increase it. So basically borrow against the position, dollars, swap those dollars back into more of the LP'd assets, put them back in. And then loop that so that they 5x or 10x the liquidity they're providing. Other cases they want to like hedge risks, so borrow like one of the assets basically so that they could try to maintain neutral exposure. That's like how market makers do things off chain a lot. They like borrow one side of the LP position, which sort of helps to limit some of the exposure, and then they'll try to like rebalance that exposure over time to remain neutral. Remain neutral. So yeah, these two things are kind of big problems that in DeFi, I would say, have been for many years since I first entered the space in 2020. People always tried to like figure out ways to bring more yield by like putting tokens from Aave into Balancer or like things like that, or to maybe try to collateralize tokens from DEXs, like collateralize Uniswap LP tokens and things. And generally, like we found some success, but it's a little bit clunky. It doesn't work very well. And we realized some time ago that with the design we had for Euler, that we could actually do this in a much smoother, composable, friendlier way by leveraging the liquidity that's already in the vaults. And the way it works fundamentally is that you have the assets in the vaults. They can be used for lending. That's their like maybe first that's their like primary use case potentially. But then you can also connect two vaults and enable as like an AMM on top of them. So supposing you put USDC into a vault and ETH into another vault, you'd be earning lending yield on both of those. But you can also then enable like build your own AMM curve on top of that position, and then let somebody else, maybe me, the swapper, come and rebalance the amount of ETH you have and the amount of USDC you have inside of Euler. And so I can rebalance on your behalf. And obviously at the end of it, you'll have earned swap fees and lending interest, but you'll have a different composition of assets than you started with. So that's the simplest, like ordinary LP type position, I would say, where we basically just make the lending, the liquidity much more efficient by letting it earn yield by default, if that's what the LP wants. But the really cool thing is then how we utilize, because the assets are already held in these vaults, if those vaults are accepted as collateral elsewhere in the system, you get the ability to borrow. And you can borrow in the way that you would expect, just like taking out an ordinary loan, like just borrow and then do what I said, like maybe leverage the liquidity or hedge or whatever. But the really cool thing is that you can also put assets into the vault and then borrow just in time. And so this just-in-time facility is extremely powerful, I would say. It allows you to massively amplify the amount of liquidity you have on offer. So yeah, let me give you a quick example of that. If I have $1 million of USDC inside Uniswap, the maximum swap size I can facilitate is like $1 million, right? Someone can swap out all my liquidity in return for some other liquidity. If I do that inside Euler Swap, the maximum trade size I can facilitate is actually $50 million. Which is an insane number. It's 50 times the amount of initial capital that I've supplied. And the reason that's possible is because on one extreme, with $1 million of USDC in my account, I can potentially go leverage long USDC versus USDT. So I can go leverage long Circle's stablecoin versus Tether's at 25x. And then I could also potentially go the other way, and I could go leverage long Tether versus Circle, 25x. And what that means is that if I'm at one side of the pool, like in that case, like I've got this leverage long position USDC versus USDT, if you then came to me with a $50 million swap and said, can I swap this in? I can basically facilitate that. I can use the swap input amount to repay debts and then collateralize the remainder. And then I can borrow the amount that I want just in time and send that back out to you. So that's fundamentally how it works. Just-in-time liquidity allows you to collateralize swap input amounts, borrow swap output amounts, and send that back to the swapper. And it's really cool for LPs. It provides this massive new opportunity for LPs because, well, we could talk about lots of the use cases, but just like one thing that's really cool is that you basically earn leverage swap fees, right? In that situation, I've earned swap fees on a $50 million trade. So I'm generating volumes which are much higher than I could expect to generate on Uniswap. And so, yeah, I can potentially earn lots and lots of swap fees using this, or provide more competitive quotes depending on what my objectives are as an LP. And there are risks involved too, which we can get into, but that's fundamentally, yeah, the use case for just-in-time liquidity.
Yeah, thanks for the explanation. And yeah, to maybe summarize it, so first of all, one of the issues that we all are very well aware of, especially from like the AMM world, is that a lot of liquidity sits there idle, not earning any yield or not being utilized at all. We at Arrakis know it better than anyone else. And the idea was, okay, how can you actually, with the emergence of hooks and Uniswap and then new lending borrowing markets, is how could you actually maybe by default have all the assets being lent out, and then sort of pull them into an AMM or a decentralized exchange to facilitate swaps just in time, right? So this is one thing. So your assets are actually always used, and then only for like an instance of like a transaction within a block they are being used to quote. And you have this virtual AMM which sits there, but the assets are actually not there. They're lent out, and then you pull them in within just like a transaction basically to facilitate trades, right? And then of course you earn the lending yield, which is amazing. But then the really interesting thing is if you like combine these collateral positions, and you can you actually leverage into you use leverage. So you start out with 10 million, but you might want to facilitate a swap of 50 million, and then you have let's say a yield-bearing asset as collateral, and you need to provide USDC because someone is liquidating a position. Then you can actually, even though you just have $10 million in inventory, where you maybe would have like a 50-50 split in like in an AMM, like on Uniswap V2, let's say, here you would just have like the collateral asset on one side, and then you have this like virtual AMM curve where you can provide liquidity by borrowing assets just in time, but you can borrow way more than what your inventory is by going leverage, because the swap gives you additional collateral that you can then use to lever up and so forth. And this is actually like we can go into some use cases now. This is actually a business case that we have right now with some of our customers. One of our sort of like flagship strategies is a yield-bearing asset strategy that we are running right now in Uniswap V4, which is basically like following the drift of yield-bearing RWAs and making sure that you have consistent sell-side liquidity in the market to like facilitate redemption, like liquidations, redemptions, and so forth. Prime customer here is Maple, for example, that is using it right now. And of course, the liquidity is limited to what the customer that uses Arrakis provides. But now with this primitive, you can 5x that, or you can 10x that based on your risk appetite, and you can source the inventory that you use to quote in the markets from lenders, right? That open up a whole sort of new world. Yeah, which is of course fascinating. I think that's why we of course are interested in it, and I think everyone agrees that it's probably taking off right now, especially for stable pairs. I think is what we're seeing, right?
Yeah, there's definitely like those use cases also extend to like even real world assets, right? So a lot of those assets are kind of permissioned or semi-permissioned, and that means that it's hard to put real, just raw liquidity into Uniswap or whatever else. You have to put, some kind of BIDL, let's say, a BIDL USDC pair. It doesn't really exist, right? But with this, you can have a pool, a BIDL, which is permissioned. So only whitelisted holders of BIDL could deposit into the collateral vault. And then you could have like single-sided kind of just-in-time liquidity, so that anybody who wants to exit BUIDL now, rather than having to go to the instant redemption thing, which might be closed on a weekend, or maybe winter and you just gobbled it all up, the capacity or whatever, and there's nothing left for now, you can just basically swap it in, send in a big chunk of BUIDL to some permissioned market maker now, and they can borrow permissionlessly from the USDC markets to be able to swap out. So yeah, it's really powerful, I would say, for those kind of use cases, for things like SUSDE as well, like the yield bearing things, where you always want that liquidity. Like you always need that exit liquidity basically for those assets, and it's very, very expensive to provide normally, as you guys well know. Finding that liquidity, sourcing it from somewhere, especially when it's going to be used fairly inefficiently, and the swap fees aren't going to be huge, and all the rest of it. It's very, very costly to find somebody to put a huge chunk of that into just a liquidity pool on Curve or Uniswap or wherever else. And this kind of solves that, because you don't need to have that liquidity there and then, or not the whole amount anyway. You just need a small amount, and then you can borrow the rest of it just as you need it, which massively lowers the costs for LPs.
Yeah, exactly. And I think if you actually think this through, let's say for like a yield bearing asset to USDC sort of pair, then like what it actually boils down to is like a lot of them want to redeem via the native 4626 vaults on chain, and then suddenly it all got gobbled up by Wintermute or something, right? And then like the queue starts accumulating, and then probably like maybe some lenders like withdraw their money, and suddenly borrowing rates spike, and all these leveraged positions that people have are now not profitable anymore. And then the dialectics and whatnot of the world that are farming rewards or whatever, they need to delever. And then you need to have some spot market liquidity. Previously, let's say we did on Uniswap directly via just like the normal AMM curve. And now actually there's interesting that now you basically have these users that usually want to liquidate other ones that are actually already leveraged in the lending markets. And now you as a lending market, borrowing market user basically will, like at the end of the day, it's sort of like a debt transfer, right? Like you're transferring the debt from like someone who, let's say, deleveraged into you as like the lending market or borrowing market liquidity provider on Euler Swap, and you basically do like a swap of the debt, and they pay a spread on this, and you're fine with taking this over because you might have a longer duration, or you're fine you're fine with paying these borrowing fees, these maybe increased borrowing fees for like a certain period of time before then like redeeming through the 4626 vault, for example, right? So this is this. Yeah.
Exactly right. Yeah, and then I think for now we have a system where it's not the options for the person, the LP taking on the debt are, they're really just choosing where they borrow from at the moment. But we've already had some really amazing feedback, and we've already got Euler Swap V2, even though we've barely brought Euler Swap V1 to market yet. But based on feedback we've had from institutions and other people that are interested in using this, we've already realized that there are like little extra features that we need to add that enable the person taking on that debt to kind of set additional rules about when that happens. Maybe they can change their fee, they can charge asymmetric fees, or they can be more reactive in terms of when they allow these kind of swaps, or when they allow a debt position to be taken on, for example. So but that's exactly the right way to think about it, I think.
We already have a ton of feedback and ideas where we know that the current system is like single vault pair, right? And then you cannot go across many, and we actually need to update like what Arrakis does. We need to actually actively manage the like bits and asks on chain, and like how can you actually more effectively do that? Like that, we can spend maybe like a more private session talking about those. Maybe like a question I have, which is a bit technical, is you guys integrated like the sort of like Euler Swap controller, or what is called the Euler Swap basically system
operator.
It's built as a hook, a Uniswap V4 hook, right? So it does not actually like leverage any of the underlying sort of AMM logic of Uniswap. It just like basically sort of taps into the routing. Was this like just like a nice sort of like hack to get the integrations into all like aggregators and so forth, or how do you think about this design?
Yeah, I think I think that's yeah, that's directionally right. Like it's mainly a way for us for Uniswap to kind of build into the Euler system and vice versa. As you mentioned, we don't Euler Swap doesn't use the tick maths of Uniswap. Every position is based on a curve, like a brand new curve that we designed. So yeah, we don't have that tick liquidity, which provides trade-offs both ways. I would say it's kind of an important part of the system. Not having ticks is really useful because ticks have like a defined width, and so you see people playing games with other AMMs where they're like keep narrowing the tick width. So they can provide deeper and deeper liquidity on USDC versus USDT to like juice the volume stats. But if you don't have ticks, then you effectively the tick width is one way, and so that's kind of what we have. So we benefit from that for stable pairs, which is that we have you're very customizable like liquidity, depth sort of chart and price impact chart in terms of how you think the shape of the AMM and everything. So that's very useful. It also makes things slightly more composable and various other benefits, I would say. But yeah, fundamentally, we don't obviously put the liquidity into Uniswap either. Like the liquidity sits inside the Euler vaults as well, so we kind of bypass that. But it does mean that we get to build into their system and benefit from order flow and the solver network that Uniswap V4 has, which is obviously much bigger than you would get if you were just building an AMM from scratch. It takes a lot of time to persuade people that your AMM is going to be valuable and provide these solvers with nice opportunities to win volume.
It took ages. Like we've been there. We like launched a hot AMM with the Valantis framework at the end of last year, and yeah, just like the integration with like solvers and having them figure out how to use it. You basically have to build your own solver, win against them. And then they come, and then they're like, "Oh, how does that work?" It takes way longer than what you expect. So I think that was a very smart move.
We had quite a cool thing that happened on launch before we actually launched. I think we were playing around with the system and we deployed this pool on mainnet, and we did something like really naive. But like for like 2 minutes, we thought like there'd been a hack or something because we were. We basically deployed this USDT pool. Not a large amount of liquidity. I think it was like hundreds of dollars, maybe $1,000 or something, right? Like enough to be interesting, but not enough to be a major concern. And we put it in, and naively we set the price as 1-to-1 as like where the initial price of the pool would be in the center of concentrate liquidity. At this point, we had no solver integrations. We've not really spoken to anybody, so we just set this pool up, and we just like noticed straight away like that the liquidity had kind of like gone. Our USDC, we're like, what happened to our USDC? And when we went and looked on chain, we'd actually been arbed. Like we just configured the pool really badly. Like USDT does not trade at a price of 1-to-1 ever almost. So we misconfigured the pool and got immediately arbed. But it was like the dark forest like coming alive and just kind of gobbling up the opportunity. And that was mainly, I think, because we have both a Uni V3 or Uni V4 and a Uni V2 interface, and so anybody that's built, solvers to kind of detect these things already, they tend to like pick up the pools and just like solve on them automatically. It seems. I guess it's maybe like a throwback to the days where, in the early days when people would fork Uni V2, for instance, they were just the fastest way to pick up and like win in the competitive world of solving was to just scan every contract, look for Uni V2 interface, and then like add it into your like whatever tools you're using to like solve the best routes basically. And it seems like even though we do have a lot of integrations now onboarded, I think OpenOcean just confirmed they've added us today. We've got Matcha and other people, like lots of big solvers are kind of added already to Euler Swap. But yeah, even without all those, we're getting volume organically. It seemed from all nice toxic flow, but all volume nevertheless from these random dark forest solvers, I guess.
Yeah, I think this is actually a good point to of course, like how I basically view credit base and just-in-time market making, which so like I define this concept as curious. Like, do you use this? Like, what sort of terms do you guys use internally for this?
I think that's a nice one, actually. I might kind of start using that. I mean, we've sort of floated around on lots of different terms. We I think at one point we were going to say like flash liquidity, like by analogy with like flash loans, and Fluid obviously has a similar system. They say smart collateral and smart debt. It's kind of an interesting way to think about it. Slightly different, of course, from what we're offering, but similar concepts, I think. And yeah, so I don't know, actually. Yeah, credit-based market making is probably a very accurate and like, yeah, nice name for it.
Yeah. And so I think you just mentioned Fluid. I think Fluid also, of course, were one of the pioneers of like this design, and of course the Insetup team have always been crack devs, building some cool stuff. So shout out to them as well in this pod, Samyak and the guys. And yeah, so there, of course, there was this whole, like they really rose in volumes, I think, lately, right? And I think there was also this crypto Twitter drama with the ETH-USDC pair, where I think the risks that now get imposed on liquidity providers became evident, right? Which is, hey, you can use credit to do market making. So you can borrow single-sided, or you can leverage up into positions, and this can amplify the fees, but it can also amplify some parts of the formula that are more on the negative side, right? So if you look at the returns here, right, you usually have like, okay, what are the lending yields you get? What are the trading fees you earn? But then, of course, what are the borrowing rates you pay? And then you have impermanent loss potentially, and of course loss versus rebalancing, which is the sort of like toxic flow that you would receive from having stale prices compared to like interest exchanges. And I think there it became evident that if you do this for uncorrelated pair like ETH-USDC and you lever up, then you not only amplify the good side, the trading fees and the yield, but you also amplify the bad side. And so yeah, how do you think about these risks, and how do you, what sort of like do you think these sort of like volatile pairs will also see the spotlight on these kind of credit-based market making designs, or how do you reason about that?
I think there's opportunities there. Yeah, I mean, the simplest thing to do is to just not use the amplification, not use the borrowing facility. I think not use debt, because as you say, once you start building leverage, you leverage your fees, but you leverage all the other nasty stuff as well. So there's no free lunch, as they say. Like ultimately, if the benefits outweigh the costs, then you always want to leverage. If they don't, if it's not clear, then leveraging can add on all sorts of extra risks in terms of liquidations and other things as well. So it's probably best to stay away from that. So only when the just the raw benefits outweigh the costs, then you want to like loop up as much as you can, I suppose, which is what people do on stable coins and stable pairs generally. But there are still opportunities there, I think. I mean, some really interesting ones on the volatile pairs, for instance. One strategy that that people do for market making just generally is to basically borrow one side of the asset. Like a lot of projects, right, when they do market making with Winton or whoever, they'll give them a loan, and then the market maker will use USDC or ETH, and they'll pair that with this loaned asset. And over time, the way the market maker will typically rebalance, as they sell more of the asset, they'll want to make sure that they're like hedging that exposure basically. You can do the same types of things on Uniswap today, right? You can basically deposit USDC, borrow some ETH from Aave or whatever else, and put the ETH into the protocol. And then at that moment in time, that instant when you first create the pair, you're actually neutral, right? You have a loan from a lending protocol, but then you also have the same equivalent amount in the LP. Now, as the price goes down, what happens is the amount that you have in the LP goes up, right? And you can kind of pair that by rebalancing the exposure that you have on the lending protocol by going long or short, constantly rebalancing. It's very, very costly to do that though. Typically, you have to, it's kind of clunky and unpredictable. You can actually create the same type of exposure by using just-in-time liquidity, where instead of like having a permanent loan somewhere else, you only borrow just what you need just in time, and then you only need to hedge that tiny little bit. And so if you think about it, if you rather than taking out a loan of, I don't know, $1 million worth of ETH, if over the course of a period of time you just end up borrowing like $100,000, then you only need to hedge that $100,000. So it ends up being much, much cheaper by using just-in-time liquidity, and you get exactly the same like risk-reward profile as you would get elsewhere. So I think that's quite nice. The other thing that you can do is create brand new types of delta neutral strategies. As we know from Athena and the success of Athena, you often get paid to go short on perp exchanges. And so you can set up LP positions where you maybe go long on the kind of lending markets, and then go short on the perp markets. And oftentimes then you will actually kind of be getting paid on both legs. And it really depends on which asset it is and how liquid it is and how sophisticated you are as a market maker, whether you can actually run these strategies where you have, Euler Swap on the one hand, occasionally going long on the ETH pair, and then you basically want to pair that and like do the counter trade on on a perp of your perp exchange of your choice. But yeah, if you can set that up, then actually you can use just-in-time liquidity so that you accept one directional trades where you'll say, I only want to ever go long ETH, so I only ever want to be taking on board more ETH and basically borrowing the USDC side. And with that, yeah, you can almost certainly get paid on both legs of the trade and make market making very, very profitable. But it's quite a sophisticated strategy you need to run to do that, I think. So yeah, there's definitely a lot of promise in that direction, but I think it will get realized as we see more sophisticated actors, people like yourselves and others that start to understand the system better and realize that they can do those kind of things. My general view is that just market making ETH USDC in a very naive way is very, very hard to do profitably. Even if you add the lending yields on top, it's just quite hard. And lending yields maybe help you overcome that some of the time, but not always, as we saw with Fluid. It can go wrong. So yeah, it's something that's best left to the pros, in my opinion.
Yeah, we are. I think the passive LPs of non-actively managed strategies have nothing to do in the ETH USDC war. Like we sort of like for like an experiment, we launched a sort AMM some like end of last year, and we were able to get like over 10% of the retail ETH USDC order flow on chain, being the second largest market maker behind Wintermute. And we already realized how brutal it is and how small the spreads are and how much informed flow there is from like these centralized market makers and with either OTC desks and so forth. And every time dips happen like 10 seconds before, you get a huge order that you are filling. And so if you're not stopping to quote at certain times, if you're not managing these spreads actively and work together in like the MEV pipeline to avoid like LVR and so forth, you just get wrecked. So it is extremely difficult to become profitable. And I think, yeah, I really like this design of like, of course, the delta neutral with the perp and the funding rate, so paying you on this side on the lending rate, paying you long on the auto swap side. I also like this sort of like market making approach where you actually borrow ETH against the USDC collateral. You like go short and just have like a single side collateral asset, and it's sort of like traditional market making where they sort of settle every 24 hours into fiat or into like stables and then like start again, right? And then and that's their like way of doing it. It's sort of like something similar. I think there are many cool ways that basically. So I look at this as like a tool chain for sophisticated actors to come in and basically provide way more capital efficient and sophisticated strategies on chain that hopefully at some point, like due to like composability, leverage, and capital efficiency, can rival like what you can actually do on centralized exchanges, bringing more flow on chain and like accelerating the adoption.
Yeah, I mean, I've always been a bit skeptical about that, but I think when you add in the lending yields to the mix and the fact that you can actually leverage these things like natively, so you get leverage swap fees plus lending fees, but then you get like, you're suffering this, you're getting hurt badly on the IL or the loss versus rebalancing. But if you can counteract that buy also something that's either neutral or paying you money on the perp side, then I actually think you can probably do better on chain than off chain in some situations, because all that other stuff is just not possible. You don't typically get paid, lending and borrowing APY on top of the swap fees that you're earning on the centralized exchanges. That just doesn't really happen to my knowledge. And similarly, yeah, getting that leverage liquidity is also like quite expensive to build up. Usually it's much more expensive to take out those loans and all the rest of it. These guys are paying a fortune on, well, now Wildcat, but back in the day, with all these like off-chain credit agreements and stuff. The cost of the liquidity that they're using to be able to like leverage positions as needed is really expensive, and it just tends to be cheaper on chain a day at least, like to get that kind of credit. So yeah, I'm optimistic for that side of things, even though it's definitely going to take some time for it to emerge and do well. I think there's also one thing I wanted to just like quickly shout out whilst we were talking. I think someone used this already on Euler Swap, which is you can actually use it to close a leverage position, where you kind of like configure Euler Swap in such a way that you encourage like a single direction trade. So you basically get the solvers to just exit the position for you. This is something that people they on Euler today, they build up these big positions, so they want to go close it, but let's say it's 10-15 million dollar like on loop, on leverage on loops, and that's usually, if you try and close it in a single go, it's quite expensive. So people then will sometimes break it up and like swap and unwind the position slowly over time to try to like let the market handle it. But you're still paying fees, right? You're still paying huge swap fees, and you pay it on the notional size of your trade, which means that you're paying leverage swap fees. If you do it the other way, you can then we're going to try and make this a nice feature on Euler eventually, is you can actually close these positions and get paid for it. And we've already seen one of the people experimenting and building on Euler do that. They had this fairly chunky leverage position and got paid to have it closed for them, which they were over the moon about, as you can imagine. So yeah, there's loads of advanced stuff and loads of cool things you can do with this beyond just the regular vanilla market making.
Yeah, that's a cool one. So basically, you're leveraging like collateral and loop positions to let other people like trade against, and then you get the benefit of providing a really good price. You don't really care about the spread here, right? You just care about not paying maybe like a fee or something, and it's a no-brainer. And this is, for me, like when I actually believe that there's still this argument in like on-chain market making, especially like order book exchanges like AMMs and so forth. For me, how I sort of phrase it, for me, it's mostly like, how does like on-chain win against off-chain in terms of the amount of retail flow and volumes. It's like we will never compete in latency, right? I think centralized systems are always just more low latent, more efficient, probably more scalable for the foreseeable future, right? So we won't win there, and so it's all about this composability and synchronicity that you achieve if you by having like a single virtual machine where you can actually just in time do things, and you earn there and do this, and then you make a permissionless capital formation, so everyone can come in, put the money in there, and the sort of like competition drives down like the fee significantly, which is great for traders, but then also everyone can get the yield that you could generate from these strategies, not only Citadel and some other guys, right? So it's democratizing this yield, which then I see as like this sort of like strategy that for example, like guys like us at Arrakis and many others are probably building, and then lending markets like you guys, right? You have curators and they can just tap into it, right? They're like, hey, my lenders here that are just like normal people, they can just access this yield from these strategies because it's all in this recursive system. So I think that's pretty powerful.
I totally agree. I remember talking to Dan Robinson years ago about this and saying like about my sort of love of Uni V2, and we were talking about the projected death of Uni V2 because of how efficient Uni V3 was versus V2. It's like, but there's something just beautiful about the composability that Uni V2 provides. It's very simple, and those tokens are like much more composable than the NFTs that you get on Uni V3. And I think you can't discount that. Like and obviously it's still around, right? People, for better or worse, they love Uni V2 and the composability it offers. What's cool about these credit-based market making, as you call it, is I actually think it could, in the most bullish case, completely swing things back towards actually market making being better on chain than off chain again. Because what we are seeing, in my opinion, is that stablecoins have massive product market fit, and what follows on from the product market fit of stablecoins is credit protocols. Like, just, I mean, I hate to call them out, but like, well done to Aave, 60 billion. It's just incredible, right? There's very, very strong product market fit for on-chain credit. And if it turns out that credit-based market making is kind of just fundamentally better than doing it off-chain, then maybe that's something that can actually rescue rescue market making on chain, which has been something people have been like saying that it's been doomed for years, right? And slowly but surely, I think we might start to see it swing the other way. That's certainly possible, in my opinion. So, keeping my fingers crossed.
Yeah, we at Rux, we're 100% convinced that this is the case. I think the effects that you get from composability and synchronicity and more higher capital efficiency will at some point outweigh the drawbacks of latency, overhead, and also like LVR and like stale pricing and so forth, which cause a lot of the unprofitability. There are interesting designs out there that like try to solve it. So I think it's all coming together, and I think that's why I'm personally super excited about like this on-chain market making space. And then of course now with the convergence of lending borrowing, I think it's just getting more and more powerful, which is super cool. And definitely shout out to all the lending markets for their success and like driving the space forward with Aave, of course. 60 billion is massive, and you guys as well, Morpho, you're all doing a fantastic job. So rooting for all of you. Now, maybe going a bit into the technicalities of we mentioned it before. Fluid is of course like also shout out to Fluid, of course. They are doing a lot of great work. So I think there's some similarities in your systems, right? I think there are also some differences. And we just talked about like some sort of edge cases that occurred there. So how would you articulate them, and what do you think is like maybe not pros and cons, but where are they sort of like where do they have different design decisions?
Yeah, there's quite a few places, honestly. I mean, I think one of the key ones is just like in the way that underlying lending market is designed. I mean, Fluid is more like a pair-based system. So it's more like the underlying lending market is kind of isolated, which of course has pros and cons. It depends what you want to do. I would say, we know that like it's better risk isolation, I suppose, but it also can make things less capital efficient and make it harder for borrowers in some cases. So it really depends. I think with Euler, because we allow cross-collateralization, it allows some really interesting, more efficient types of market making to emerge. That we've kind of like similar things to which we've maybe seen on Curve, or there was some new thing that Dan Robinson or Dave White posted about recently. Where they have like multiple pools basically all connected to one another. So if you look at something like a Curve 3 pool, right, it's not just a pair, it's actually got 3 assets in it. You might have like USDC, USDT, and DAI, for instance. And what's neat about that is it's more capital efficient, right? You would now allow trading between any of those 2 pairs, but you don't have to have multiple pools. You don't have to have a USDC to a DAI pool, a USDT to a DAI pool, a USDC to a USDT pool, right? You've just got this one pool instead of those 3. And if you add more assets to it, obviously it just grows, right? The number of possible pairs that you have to have is very, very large. And that in turn fragments all the liquidity and so on. What's nice about Euler Swap, in my opinion, which I guess isn't possible on Fluid because of the pair relationship, because we have these cross-class relationships, is that let's say you have one stable coin, USDC, and it's within a cross-collateralized market with, let's say, 9 other stable coins. That single pool of capital can actually be used to facilitate swaps. You can have like LP positions that facilitate swaps with all the other different pairs and on all the possible combinations, but you're always still tapping into the same underlying pool of liquidity. And so that helps limit that like fragmentation of capital, I think, and make things more efficient. So that's one fundamental difference. That just comes from the differences in like where they came from when they were building things. They built like a very specific type of product, I suppose, was we built this like very flexible lending protocol and have a swap protocol on top. So that's a key difference. I think the just-in-time liquidity is something that we have that they don't. So that ability to collateralize swap input amounts and then borrow just in time to provide the output amount. That's unique to Euler, I guess one of our innovations. The trade-off there is that we don't have smart debt. So Fluid have something called smart debt, where if you were borrowing USDC and USDT against ETH, so let's say you were long ETH, you can actually allow people to swap the debt position that you have, and maybe you don't care, right? You just want to be long ETH, so you allow people to swap your debt in and out of USDC, USDT, and that helps generate swap fees, which bring down your cost of borrowing. So I think that's a nice innovation that they bought. We both have smart collateral, so that ability, let's say the opposite, you now have like USDC, USDT, and you're borrowing, I don't know, USDE. You can in both cases we can allow people to swap between the collaterals there, and so our collaterals in our cases will be earning us lending yield and swap fees now. So we both have that, and that's definitely a similarity we share. I think they're the main differences that I would articulate for now. I imagine both of us will keep innovating. I know they've got like a V2 coming out soon. Obviously, we've said Euler Swap will have its own V2 coming out in the near future as well. So yeah, we both come at this like converged on somewhat similar ideas over a similar-ish time period as well. I mean, Euler Swap was actually started being built 2 years ago, really. And it only came to life because of everything that happened in between for Euler, which has been fairly complicated, and it took us some time to get the lending protocol up and running, as we discussed, and everything. So yeah, it's an exciting time, and I'm sort of it's great to see them doing well as well. They're lots of volume. We also had lots of volume. We in our testing phase, we did a USDC to USDT pair, and we hit like $1 billion of volume in under 2 weeks, I think, with just $2 million worth of collateral, which is just like insane numbers. And I wouldn't say it was an interesting test because obviously it was mostly just toxic flow and all the rest of it. So it's not like it was something that's necessarily sustainable, but it really helps showcase the power of just-in-time liquidity, I think. So yeah, both of us in that regard have managed to showcase like the ability to do serious volume with less capital than you would traditionally need if you were to try to put it in one of the older DEXs.
Yeah, and of course for stables, I think you definitely be volume hungry. I think as soon as you also go to volatile pairs, I think the skill is to actually avoid volumes sometimes, right? You don't want to get taken at certain points in time. So this like active component there is what we learned is extremely important. But yeah, I think fully agree. I think Fluid like flipped Uni V4 in daily volumes at some point last week or so for like a day or so. So they already basically have proven that this is an amazing primitive, and so does of course your growth. And they also have been cooking on it for quite some time. Remember, actually, end of 2021, after we did this, like Arrakis had this first like really big leveraged LP position in MakerDAO, where we had like $1.4 billion in TVL because we had DAI USDC. We basically functionalized Uniswap V3 positions for DAI USDC, and then Maker added it as collateral, and then you can leverage in like 50x or 100x or something, and then we were the entire DAI USDC market, and billions of TVL. And we talked about this, and he was already explaining me like how you can take this further with something like this. And back then I was, but then I think it took them like a long time to actually ship this because they're also doing 100 million different things, right? And and at that point in time, I didn't quite get it. But
I have to admit, when I read a blog post, I think maybe from Sam or someone else in the early days of Fluid, and someone asked me like, "Oh, is that going to be similar to any of the stuff you're doing?" I was like, "I don't think so." Like, I couldn't really I mean, it's all brand new, right? So it's kind of a little bit hard to articulate like how these things work. It's obvious to me that it's very powerful and to like people that grasp it. But when we first got these ideas, it's sometimes a little bit difficult to put them in terms that people understand. And I have to admit, I didn't necessarily know how Fluid was going to work until I saw it live, and then yeah, certainly grasped it from there.
Yeah, same. And also, I don't know, I always talk to Samyak, the CTO, and he's also Giga Brain. And then I sometimes just get lost when he talks to me. And then the dogs also could have been improved a bit. So if you hear this, Fluid, improve the dogs. I think you guys' docs are actually quite good. So by the way,
oh, thanks. Yeah, we try. There's always room for improvement on docs. It's one of those things that's always hard to prioritize, right? It's I think some of the best docs in the industry are probably Uniswaps. Like they just have really, really nice docs. They've obviously spent a lot of work and time on that, and I think they're really valuable. But it always feels like so much more important to be doing, you know, all the other stuff. And so yeah, I totally get that.
Yeah, tell me about it. But yeah, our engineers said that your docs are definitely quite well written. So shout out to the person who writing the Euler docs, or Euler Swap docs. Cool. Maybe to round up this sort of Euler Swap conversation. So we've been, of course, talking, like this episode was most mainly about it. How would you classify the importance of Euler Swap for the future? Like, of course, right now it's still like growing, right? But how would you, from like what you have seen thus far, classify the importance of Euler Swap for Euler, or in general for sort of lending borrow, like a concept like this for lending borrow markets moving forward?
I think it's going to be, for us, it's a really important distribution channel, I think, and helping grow the technology and bring more yield, honestly, to the markets as well. Euler as a lending platform has grown quite rapidly because we tend to do quite well on yield. So it's like a platform people like to borrow on, and that generates outsized returns. It means we've had to distribute fewer incentives than competition, for instance. And so, yeah, we've always been thinking about like how can we make the markets just like more efficient, and be very like big believers in just like pure efficiency driving growth, because we haven't always had the same budgets that others have had to go out and just like throw, you know, incentives at it. So we've had to be quite strategic there. And that was my initial thought, was, yeah, if you can get people trading on the liquidity, like the just-in-time liquidity especially, will help generate extra yields. And just make the overall markets, more efficient. And I mean, for the same, like roughly the same sort of risk profile, the type of collateral exposure you have, you actually can get extra yield as a lender. That was one idea. I think it was also just something I'd wanted to build for a long time as a DEX, because I felt like we had good ideas and like had the right engineering team and the right expertise. Like it's something like a design space I've been interested in since before I even started at Euler. So I feel like where it's capturing volume and being able to grow revenues is kind of important. And lending protocols generate significant revenues only once they get to a certain scale, I would say, whereas DEX protocols historically can generate revenues, you know, right from the word go, and generate quite significant revenues quite quickly. So for us, it's also about finding ways to increase revenues on the protocol. And the nice thing then about having lending and borrowing in the same place as the DEX is that you can, depending on what the best strategy is, and who knows what that is today, but you can kind of use one as a loss leader for the other. Instead of having to compose, you know, Uniswap and all their fees with like Aave and all their fees, you could, if you build both of them, you can kind of maybe outcompete the market by lowering fees from 1 to 0, or even paying people, or vice versa, right? And then you have this like incredible product where you're able to undercut other people. And just it's just a great way to like bring users to the platform and everything, and kind of grow distribution channels that way, I think. So it is important, really, really important, I think, that we make our Euler Swap a success. And as I said before, I do fundamentally think that doing it this way and having that composability, lending and borrowing and swapping in one place, is a way that we can actually make people flip this question of like whether swapping can survive on chain on its head, and to like go the other way and go like, wait, can they make swapping off chain like successful still, even though people aren't earning all the extra lending yield, and it's not composable and it's not transparent and all the rest of it. Yeah, can we flip it on its head? I think that would be my biggest ambition, but that's we'll have to see on that whether it's possible.
Yeah, we'll see. I'm pretty bullish on this. We have some cool things cooking here, so I'm pretty sure we'll see some successes. And yeah, if you look at the DEX to CEX sort of like ratio, of course, like driven a lot by like meme coins and like hyper liquid in certain areas, right? I think we sort of like hit over 50% recently, and yeah, I think I'm pretty sure this trend will continue. So I think all assets will move on chain, everything will move on chain, and then exactly these composability functionalities will provide the benefit over the old system. But let's see, we'll find out. Yeah, cool. So maybe this wraps up. So like Euler Swap, or is there anything we haven't discussed yet about Euler Swap that you think is like worth mentioning to like explain the potential, or like a great use case, or anything on your mind?
I think we've covered most of it. Yeah, I just probably reiterate that since you mentioned that all assets going on chain, I think a really unique use case here is for real world assets, even ones which do have extra permissions on and so on. You can really use Euler Swap, and it's just in time liquidity function, like an instant redemption facility, as an alternative to an instant redemption facility, to provide much deeper liquidity for assets that are sometimes tricky to get liquidity on chain for. And what's really nice about that is that I think we have this probably slight chicken and egg problem with assets like some of the tokenized treasuries, for instance. Off chain, they're absolutely huge. Everyone's constantly using them to park capital in, either for short or long periods. But yeah, they're very widely used. But on chain, because there isn't that way to move in and out of them like very seamlessly, it seems like they're less frequently used. And I think that's a shame, because right now, obviously, we're in more of a bull market, and the rates on chain are very, very good. But when we go into bear markets, sometimes we've seen lending and borrowing rates drop below like the T-bill rate, which is just ridiculous, right? There's no matter how much you love any of the lending protocols out there today, there's no way any of them are less risky than just putting money in T-bills, unfortunately. I think they're clearly, the rate should always be higher on chain in a lending protocol lending to a volatile crypto asset or some other stable coin than they should be than just putting money in T-bills. So how do you fix that? Well, you need T-bills on chain, where people, like, if the rates decline, like people would, just like they do off chain in TradFi, they just move into like these lower risk assets, but on chain versions of them. And if that's going to happen, though, those assets need to be like exchangeable more readily somehow. And yeah, I'm sort of a really big potential use case for Euler Swap, I think, is the ability to service instant redemption like facilities in a crypto native way for those assets. And with that can like unlock a lot of the blockers that are stopping them growing on chain right now. And then with that, we can really start to like suck in more and more of TradFi. So yeah, that's one of our other more ambitious goals for the next few months that we've been talking to various institutions about.
Nice. Super bullish on this.
Yeah, keep your eyes peeled on that.
Yeah, for sure. Cool. So maybe just like a couple of questions more about like how you see like the future, not only from like Euler Swap, but in general for like lending and borrowing, sort of move towards, and like based on my conversations that I had with all sorts of founders and lending in the lending space, I think there is certain set of like trends that I see that I would like to get your take on. So first is fixed rate lending. I think we are bringing it back from the good old days, like Dharma and so forth. Shout out to those guys from back then. And of course, like back then, like these P2P loans, or ETH even, right? Like, so these P2P loans were like not scalable at all, similar to like order book exchanges on chain, like not being scalable because you're like matching against other people's orders, and you needed these like pooled versions like Euler V2 for trading, and then like Aave and a compound for lending, and then you guys as well. I feel that now the systems are getting way more sophisticated again, because you have active managers, like let's say Arrakis on the trading side, but then you have the curators and so forth on the lending borrowing side, that are able to like bridge that, be that sort of like a middle man in a sense, right? Or there's this layer in between the sort of like more P2P system and then like the borrowers and lenders in the case. So where you could potentially even facilitate these things. So what's your take on like fixed rate lending? You guys have plans maybe also there, and how do you see that? Will this pick up again? Will we see 2025 and 6 be a year of fixed rate lending?
Yeah, big time. Yeah, I'm almost certain it will. And we definitely have plans there. We've got 2 different products that we're planning to ship on that front that we'll be coming out in the next few months, I guess, like one before the other. I mean, the reason why it's becoming back on trend, firstly, like fixed rates in the early days didn't scale. There just weren't that many users, right? That's part of the problem. Some things just work when there are more users, and they just don't scale at all at a certain level. Like even look at the Morpho pair on base with BTC and USDC. We had individual pairs where you had a single collateral debt pair back in 2020 with like Cashi protocol had exactly the same setup as basically Morpho Blue. They even had reactive interest rates. It was almost identical protocol in some respects to Morpho Blue, and it didn't scale. Like no one used it. Like there weren't just fundamentally weren't enough people. But at some scale, when things get big enough, then the inefficiencies of the system become less apparent, and they can kind of just like they can work in ways that they just didn't do it.
And Coinbase integrating like a protocol like Morpho in this case, right? That actually allows retail to leverage like a protocol to borrow against BTC, right? Which like this has happened for the first time this year with like Binance, OKX, Coinbase now having custodial wallets for the users and allowing them to interact on chain is also a regulatory change that occurred, right? So this is the big unlock for me.
That's that scale that like solving those distribution challenges. Fundamentally, that's what it was. It's just a distribution challenge, really. And those are like increasingly being solved. I think we're integrating with a lot of these exchanges and big wallets as we speak, and that will help unlock distribution challenges we've had as well. Because you can only get so far on your own website and your own no matter how nice you make it, like you're only ever going to capture just a tiny fraction of the market. So you have to find ways to distribute the tech, and I think we're seeing more and more DeFi protocols become the back end of CeFi or fintech applications on the front end. So yeah, Euler will definitely be part of that, and that distribution also helps solve some of the challenges you've seen with fixed rates in the past. I mean, fundamentally, right now, there's so many people wanting to borrow, and there's a real supply shortage, I would say, of like USDC fundamentally, or like dollar stable coins, USDT, USDC, but really in demand. And there's loads of people that want to borrow, but there's just not enough supply. And so people are fighting really hard to get the supply out there right now. When they are borrowing, though, because there is that shortage of supply on these variable rate pools, the rates tend to be quite volatile. And that makes it a nightmare for borrowers, honestly. If you're using ETH and just borrowing USDC and you're going long, you might not really care whether the rate's 5%, 15%. You're probably in a trade for like days or weeks, maybe. It's not a big deal. And it's not the main reason why you put on the trade, right? If you're in a carry trade, though, where you're going long SUSDE against USDC, you really care about the rates, right? Like you're probably much more highly leveraged, and a change in rates can change your profitability massively. So you want to lock in and try to have a more predictable borrowing experience, and that's why I think fixed rates are coming back, because on a lot of these pools, things that borrowers still just have to really actively manage their positions and be really careful with how they're doing things. So how do you solve that? We've got two solutions on Euler. I think one of them is just more of like a traditional fixed rate type of product, but it's very efficiently integrated with the rest of the lending protocol, and it uses intents and so on. And as you mentioned, like brings in the curators into the system to allow them to kind of make things more efficient in terms of how liquidity moves around, I would say. So that one's probably that's been in development for quite a few months and probably going to come out second. The first product we have is just like a simple iteration, honestly, on like the current market. So we've got a product called I still even haven't got the full name for it yet, but I think we might call it Cyclical Notes. And what cyclical notes are, essentially they are a fixed borrow cost for some period, let's say fixed borrow rate for 6 months. And then after 6 months, you have this short repayment window where the rate spikes in a pre-programmed way. Now, what that does is it provides a crypto-economic incentive to repay on time. If you don't, then all the great borrowing you just did over the 6 months is going to be kind of undone by the repayment window. And it's quite cool because as a lender, you can sit in this pool passively for the entire time. Borrowers know they've got this fixed rate, so they're probably going to pay you an interest rate premium. You don't need to have any idle capital in the system, so you earn a boost in the lending rates because there's no idle capital. You earn a boost in the lending rates because there's borrowers paying a premium for the privilege of borrowing without risk. And then you potentially also benefit from late repayment fees as well. So I'm certain that some of these borrowers are just not going to repay on time. They're going to enter the late repayment period where they have these elevated interest rates that they have to pay. And if you want to remain in the pool as the lender, you can do so and gobble up a bunch of late repayment fees as well. So yeah, it's a nice system. And what you can do then is essentially build a system integrated with Euler Swap, and you can, because in Euler you can cross-collateralize vaults, you can actually sort of have ladders of different types of notes with different maturities, different fixed rates, and so on. And I think we'll slowly, with Euler and other platforms, start to see a more sophisticated interest rate swap environment emerge as well, where interest rates are traded more actively. We already see this to a degree with Pendle and like some of the awesome products they've got. But yeah, with that tends to focus on more of these newer stable coins. I would say it's less common to use Pendle for like USDC or just core stable coins or ETH or things. But I think we're going to see massive growth in that sector as more institutions come in and want to trade those things in the next 6 months to a year.
Nice. And so the first trend that I mentioned is fixed rate lending, and you just explained, okay, Euler is very well positioned to be riding that wave. So looking forward to seeing the products come out. I think a second one that I'm seeing, which I would like to get your take on, which is sort of like related to it in a sense, is the use of intents. I think you mentioned that just now. I think there are now really interesting designs on this protocol on Solana. I forgot what it's called, and there's also like one building on Mega ETH, and Morpho, I think also I mentioned that they're looking into this. Is that, of course, we like in trading we had also these pooled models, and now like concentrated MMs and order books, it's way more peer-to-peer. But the preferences for like the normal like trader is just like, hey, I want to, here's this intent, and whatever venue like you can fill me on, please magical solver up in the sky, figure it out for me, right? And then I can define my price, and in trading it's very simple. This is my price, this is what I get, right? Lending borrowing, of course, is way more complicated. You have, instead of one order being one parameter, you have the whole spectrum of like LTV, collateral, and this and this and that has to be defined. And I think you can use intents for this, right? So what's your take on this? Have you guys been looking into it? I think you mentioned it already, right? But yeah, how would you sort of describe this evolution?
I think, as you said, it's I mean, in some respects, it's kind of the cleanest way to do things. It's also like inherently centralizing. I don't think something you could have necessarily shipped a few years ago, but I think people are more open to it now. It's nice because you're using Ethereum as a kind of settlement layer, but like a lot of the activity is actually like mostly like shipped now happening off chain again. So you kind of re-intermediating the system in some sense with like off-chain intermediaries that are kind of performing this like solving or like matching liquidity to borrow demand, that kind of thing. So it's going to be interesting to see from that like standpoint how things evolve. Mostly it's just settlement that happens then on chain. It's all the like complex stuff is kind of shifted off chain, which is obviously much more computationally efficient. I think there's some interesting questions around who should be the makers versus the takers when you're using intents. You know, who's specifying the intent? Is it the lender that says, I want to lend at this rate, and to these this collateral set or whatever, and somebody comes and fills that by matching a borrower, or is it the other way around? Like there's just like a pool of lenders, and the solvers solved it on behalf of the borrowers. I think that's I think there's trade-offs both ways, and if you think about like how credit works in traditional finance, partly it depends on like how urgent things need to be like carried out. If I'm borrowing in order to do a margin trade, I'm very much the taker. Like I'm borrowing like from the available liquidity like now because I want to make a profitable trade, right, and take advantage of whatever circumstance I've got in front of me. If I'm borrowing to get a mortgage though, right, like that doesn't happen instantly or anything like instantly. Like in that case, it's very, very different. And I think you kind of almost like flip things on its head. So like the maker and the taker is kind of almost flipped. So yeah, I think that's also going to be an interesting design space, I think, for these intents. Yeah, who are the makers and takers? I think we have slightly different, from what I can see from other lending protocols, I think we have slightly different views on where the biggest opportunities are there initially. I'm sure there are opportunities both ways, whichever way route you go. But yeah, yeah, watch this space in terms of how we build stuff in that area.
Cool. Yeah, I'm just imagining the world. Like, just imagine a world where every single loan in the entire world is just an intent, and I want to get a mortgage, and I literally just like broadcast. At some point, you probably have like identity as collateral, right? And then you just broadcast, I want to borrow at 2% to the world. And then anyone from like the other side of the planet can just say like, hey, I've got an intent that wants to lend out at this rate because I'm fine with this, right? And then you just have some people matching you, and then this is the match, this is the loan, and then it's just like cool. It's just it's like incredible, right? So I for sure see if like this scales, that this would be sort of like an end state, and then you literally have, then for me this is literally DeFi in a sense of internet money, where you have messages on the web being like transported left and right, and they're just the Lego bricks that like just build the financial system, and they're just like literally like bits being sent.
That's it. It really is. I mean, it's just an incredible vision, right? To think about it, to think about it in those terms. But I do think it will. I think it's coming. I think that's the way things seem to be shaping up right now. Unless the regulatory environment massively shifts and someone comes and dismantles it to try to protect the legacy systems, I don't think they've got a chance in hell of being able to offer anything like this. They've had their chance. Like, we've got the technology to provide it, and they've not delivered, right? So I think our industry can deliver it genuinely, or get much closer to that like perfect vision than anybody else has managed so far.
Well, we're 3 years to make it work, so let's get back to let's until potentially the US administration changes again. So let's wrap this up here. Let's get back to work. Any closing thoughts from yourself? Maybe if you're launching something, any shout out you want to give here?
Oh gosh, we've covered a lot of ground. So I think what do I want to shout out? No, I mean, come check out Euler Swap. I mean, we did like some beta testing over the past few weeks, but now we've started to make it more accessible to the public, like with that testing, knowing like where it works, where it doesn't work. So yeah, come give it a try. We're actually collaborating with the Uni Swap Foundation on some stuff on Unichain right now, and so there's some nice incentives on offer as well. If you want to come and try just-in-time liquidity provision for USDC, USDT 0. There's some nice incentives on offer there, available for a couple of weeks, I think. So yeah, that might be a nice way to get started, because it's a fairly like vanilla sort of pair. You can use just-in-time liquidity, concentrate it, use single-sided liquidity if you want. That's another thing we didn't even touch on with Euler Swap. And then benefit from some of these incentives. So I think it's a good introductory path to test out Euler Swap, and then hopefully people will start to see how powerful it is and start to explore some of the more exotic approaches for using Euler Swap.
Awesome. Perfect moment to end the pod. Michael, thanks a bunch for joining. That was a lot of fun. I enjoyed it a lot.
Yeah, that's great.
And yeah, I hope maybe we can do another one like in a year from now or something. I think that the world will look very different then.
Sure will.
But yeah, but for now, let's get back to work. Cool.
Yeah.
Ciao.
Thanks.
All right.
Great.
Let me wrap this up here. Recording. Stop recording.